Bloomberg Audio Studios. Podcasts, radio, news. This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. The Bloomberg Businessweek Daily podcast with Carol Massar and Tim Stenivek on Bloomberg Radio.
It is Bloomberg Businessweek Daily. That's Nora Melinda in for Carol Massar this afternoon on this Netflix earnings day. We are seeing shares of Netflix actually move lower in the after hours after an initial bounce higher, down right now by 1.7%. The company did report results that exceeded investor expectations in every major metric. Revenue growing to $11.1 billion, earnings jumping to $7.19 per share. The company also raised its forecast for full year sales and profit margins. It expects to generate up to $45.2 billion in sales and have an operating margin of 29.5%. Let's bring in Mark Douglas. He's CEO of the publicly traded advertising and marketing company Mountain, ticker MNTN. He joins us from Miami. Mark, always good to check in with you. I want to focus specifically with you on the ad-supported element of this. I was telling Nora earlier, I'm old enough to remember when Netflix said they would never do ads, they would never do live content, they would never do news, they would never do sports. Now they do all of those things. And more. Is the ads business working?
I think the ad business is off to a start. It can grow so much bigger. And, it's obviously growing. I think they're saying that they expect a lot more growth. But it's also in a competitive space. They're competing with Disney, with Peacock, with Paramount, Warner Brothers. And, those big spenders, those big brands, they don't really increase their budget. So if you want to come into that space, you have to take market share from someone else. Netflix is, what I would expect over time is that whatever percentage of viewership they have is what percentage of the ad market they can get. So they have a lot of room to grow. It is working, but it's still relatively small compared to where it can be.
I find it really interesting. We were discussing how people are willing to pay for these subscriptions, even if they do contain ads. I can literally remember when you would watch Netflix all the way through, no gaps at all. But it seems as though this is a really thriving part of their business here.
Yeah. Well, why did they add the ads? Because their customers wanted a lower price point. And so it's a simple trade-off. We'll give you the lower price point if you'll let advertisers pay for part of your subscription. That's effectively what's happening. And so the customer's getting what they want, and Netflix is getting the revenue they need, in order to make that possible. So it is a win-win. I'm not sure everyone that gets ads thinks it's a win, but it's certainly a win that they don't have to pay as much to get the content.
So I'm looking at the different plans and pricing for Netflix here in the US. There's the standard with ads, there's standard, there's premium. So it starts at $7.99 a month. You can go for premium up to $25 a month. Again, this is here in the US. There are different intricacies to this because you can pay for extra members and the like. Netflix has gotten really good at, as my brother likes to remind our entire family, understanding if you're sharing an account, and now everybody kind of needs their own accounts. Is there, from the perspective of actual growth here in a saturated market in the US, is there a concern, or is this by design, that if Netflix raises the premium price, then there will be a small portion of the folks who don't want to pay $25 a month or whatever, and instead they'll drop down to that ad-supported model? Is that the strategy?
I think worldwide, Netflix, maybe last quarter, the quarter before, essentially the last time they were reporting subscriber numbers, they said the number one, tier that people were buying was the ad-supported tier. I think it was as much as half of all new subscribers. And so people want it. They want that price point. I think what's really interesting is the way to think of it is Netflix is building a backlog of future revenue. So in other words, they bring on the subscribers that they are essentially under monetizing. They're charging them $7.99 and they're getting relatively few ads. And as Netflix increases the ad load and essentially makes more money, that is just like pure, like that's going to flow directly to the bottom line. I would expect Netflix's earnings to outstrip their revenue growth literally for years to come. It's somewhat similar to the password backlog, where they knew all these people were sharing the passwords, and at any time they can just kind of get more serious about that, and all of a sudden it produced all this additional revenue. That's what's going to happen with Netflix's advertising, and I think I have never seen a company this large that I would say should be treated as a high growth stock. That's the potential in the ad business.
Mark, one thing that was interesting to me as we're parsing through this earnings was the fact that Netflix boosted its full year revenue primarily due to US dollar depreciation. What's your takeaway from that?
Well, I mean, they're a global business. I mean, I think that's for financial analysts to really look at. I mean, obviously they don't want to be fluctuating the price points based on, the way financial markets are valuing the dollar and other things. But I think I think most investors are going to look at the growth in revenue, growth in earnings, continued expansion in national. And I think the most important value for Netflix, which is not really explicitly measured in numbers, is through surveys, they are the first place people go when they turn on their TV, is they turn on Netflix. And the amount of power that gives this company it's almost hard to state. That's how they can turn, like fights into like numbers that rival some of the biggest sporting events, or turn WWE into, a big show on Netflix where one has been as big as another channel. And if I'm an investor, I'm going to be, as long as Netflix is the first place people go, it's going to be the first stock I want to invest in. I think that's the biggest correlation.
Hey, Mark, since you are focused on the ads business, in your view, what's a more profitable subscriber for Netflix? Is it the one who's paying $7.99 a month for the ad-supported version, or is it the premium subscriber at $25, or the standard subscriber at $18?
I think the premium is probably the most profitable, but I think then the ad-supported has the potential to become the second most profitable. I don't think it's there yet because they simply are not monetizing all those entertainment consumers at the level they could be. But when they are, they're doing $7.99 on that price point. Who knows? It might be $8.99 next year or something like that. And they can make probably equal to that in terms of ad dollars per user, and maybe even a bit more than equal to that in ad dollars per user. And you see that's what Amazon did with Prime, where they just flipped the entire customer base into ad-supported. So that ad-supported in terms of volume, because most of the subscribers, I think, will be ad-supported over time, is the most profitable. In terms of just sheer dollars right now, it's probably the premium at $25.
Mark, I mean, when you think about Netflix historically, they were initially felt like the leader, but you're seeing a lot of these other companies in here trying to additionally monopolize the space. But that being said, we did see some news earlier that Comcast is raising the price of its Peacock streaming service by $3 a month. Very fitting today when we have Netflix earnings. How are you thinking about Netflix as a potential leader right now in this space?
Yeah, I mean, that losing that leadership position is going to be hard for them because they just have to keep investing in content, and they're profitable and very profitable, so they can afford to keep doing that. But I think what you're seeing happening is the other networks are fighting back. Peacock with Love Island, just massive show over the last month. From what I know, did incredibly well in terms of revenue generation. I think it's the #1 reality show in the world. Plus they have Bravo and others. You have Disney with all the children's content, Star Wars content, ESPN now going into live sports. I think all the networks have gotten way more serious about competing, and they're bringing out their own hit content. But as long as Netflix is #1, I think it's hard for them to lose that spot. Probably the only company that can really truly challenge them is Disney.
Absolutely. It's interesting. We were just talking about Love Island. I'm a watcher of Love Island, so I see how they were able to skyrocket here.
Somebody who I'm co-anchoring with today went to like a Love Island premiere,
a watch party
or
on
finale
Friday,
watch
and I
party.
hosted,
is that right? You hosted
a watch party of my own 2 days later.
Meanwhile, I've never even seen an episode of whatever you guys are talking about. Mark Douglas, always good to see you. Fly on up here to New York next time so we can hang out in the studio. Mark Douglas is CEO of the publicly traded advertising and marketing company, Mountain.
You're listening to the Bloomberg Businessweek Daily Podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Well, signs that the U.S. economy is holding up, just lifting stocks this afternoon, as we heard from Charlie. This coming just a day after speculation about the Fed chair really rattled markets. Better than estimated retail sales and a drop in jobless claims pointed to economic resilience, driving the S&P 500 toward fresh all-time highs. Let's bring in Molly Smith. She's Bloomberg News economics editor. She joins us here in the Bloomberg Businessweek studio. I want to start with retail sales because a big rebound in June, a broad advance, 10 out of 13 categories posted an increase. Does this answer all questions about the health of the U.S. consumer? Are we all good?
God, I wish it was that easy, Tim.
It's not?
I wouldn't be here if it were that easy.
All right, explain.
It was, so I like to caveat by saying that like retail sales is, I would say, like a relatively narrow look at consumer spending, that this is a report that mostly captures just spending on goods, like physical stuff. But that's really that's a third of overall consumer spending in our economy.
I think this is a really important point. The consumer powers the economy, but services are what they spend their money on.
Bingo.
Okay.
Yes. So not to say that a third of consumer spending is nothing, but it is not the majority of where consumer spending is really directed at. So that's one thing. Second thing, these are not inflation adjusted. So when you see these increases, you can kind of do a little bit of the math, since we did just get the CPI to see where prices were rising or not. But generally, if you see a number that's up, it could be up because prices are up or because actual spending activity is up, or both. So in this case, there's probably a bit of a mix of that. And either way, though, the takeaway from economists was definitely positive, that, you know, we just had 2 months of declines in retail sales coming into June. So to see a rebound, especially of this magnitude, was definitely reassuring in some ways, you know, that maybe tariffs are not totally sapping consumer demand, at least as of yet.
But not the end all be all here, which you've clearly spelled out for us here. What were some of the highlights that you saw in this print?
I don't know if I would call it a highlight so much as a surprise that that motor vehicle sales were up as much as they were, especially because we saw the administrative data from Ward's Automotive Groups showed that car sales dropped again in June, and the CPI report showed that car prices were down. So that, to me, would spell, you know, an overall negative for car sales. Economists are saying probably a seasonal adjustment issue, because I'm not really sure how else you would get a positive number out of that.
But there was also this pull forward in the earlier part of the year because consumers were very worried about what tariffs would do to automobiles. Is that part of this equation at all? Is that why it's surprising too?
I think that there's probably still, you know, there's been so many, obviously, as we know, whiplash with tariffs. Are they on? Are they not? Is it delayed? What date? So I think, you know, there was a bit of a pullback in June when, like, we had, you know, put to rest the idea of 100+% tariffs on China. You know, that was like a pact that was reached in early May, and that we've had a bit of this pause until now we had this announcement in the past week that the really more significant tariffs are going to kick in next month. At least that's the plan right now. So who knows? We could be going through another one of those, you know, lulls right now with the tariff talk that could be boosting spending and sentiment in the meantime.
Well, let's talk about the job market right now. Of course, we got that weekly print that we always get, which is jobless claims data that came out today. We saw that the estimates were 233,000, but it actually came in at 221,000. So a slight miss here. But what are you really seeing when we think about the broader economy as it relates to jobless claims?
Well, it's a good thing when we see a miss on jobless claims. Just want to point that out. That means fewer people are filing for unemployment. So that's a good thing.
Applause.
Yeah, assuming that we're in the camp of not wanting people to lose their jobs. So that's good. And at that level of overall claims of where the initial ones have been coming in this like 220,000 area, that's very much in line with like the pre-COVID economy and would suggest like a pretty solid labor market overall. Granted, where more of the concern is happening is in continuing claims. So these are people who are continually receiving unemployment benefits, whereas the other number is just new filers. So the continuing claims number has kind of been flirting with around like that 2 million number for a while now, kind of like up around the highest levels since the end of 2021. That one has definitely been trending in a worse direction.
So for a while, it used to be bad news is good news. Where do we sit now? What do we say?
Oh, gosh. I want to say that good news is good news.
Okay.
I mean, I think, well, a lot of it is because you're thinking from the perspective of like, what happens to Fed rates, right?
Absolutely.
And so, I mean, right now, all of this data is telling you that like the economy is solid, and that this is also supporting why we're not expecting to see rate cuts in July, at least July for now. Who knows? September still seems to be a wild card.
Okay, so on this, I just want to end with you on the Fed and play some sound from one of the Kevins who is vying to be the next chair of the Fed. Kevin Warsh, former Fed governor, was on CNBC earlier today.
I think the president's language is this could be a golden age. And frankly, I think they all could be right. Good policies could advance this U.S. economy, what we call AI. In a couple of years, we'll just call business. And AI is going to make almost everything cost less. And the U.S. can be a big winner. If I were the president, what I'd be worried about is a central bank that doesn't see any of that. A central bank that is stuck with models from 1978, governance from a prior period, and don't recognize we could be at the front end of a productivity boom. And if I were the president, I'd be worried that they might not see it.
Kevin Warsh, former Fed governor, on CNBC earlier today. Molly, I want to ask you about this idea that a central bank with this dual mandate, in Kevin Warsh's view, might be stuck on old models and old priorities. What's your view on this?
I mean, I still think the priority for the Fed is definitely the dual mandate, as you said. So that's ensuring price stability and maximum employment. And I think those are still good goals to have, no matter if you're in 1970 or if you're in 2025. There are a lot of central banks that don't have both of those. You know, they just have an inflation mandate or an employment mandate, but not both. So I think that, you know, and that's also something that for us comes from Congress. That's not the Fed's own idea. This is a mandate from Congress as to what they're meant to achieve here. That said, I mean, yeah, the economy is rapidly evolving. AI certainly has a lot of promises, but I don't think that's really had any widespread impact yet in terms of like taking out jobs that were, you know, at a really widespread level here. I think it's just so far been like pretty concentrated, and like we haven't yet seen all of that. And of course, when those things are going to be happening a bit more notably, yes, the Fed wants to be acting forward looking, but like, you can't also be like, you know, acting in advance of like, if this is still perhaps years or decades away from now, who knows?
All right, good place to end it. Molly Smith, Bloomberg News economics editor, joining us here in the Bloomberg Businessweek studio.
This is the Bloomberg Businessweek Daily podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Let's talk about commercial real estate today. We had Prologis shares that gained in yesterday's session. Though they're down today, the industrial real estate investment trust industry, and that company in particular, that company delivered a beat and raised earnings report for the second quarter and beat consensus expectations for the second quarter there. That's industrial commercial real estate, and that can certainly tell us one thing. For a view on the office market, we bring in John Gates, CEO of Leasing Advisory Americas at JLL. They offer real estate and investment management services around the world. So it's got a great view on different economies and if we're indeed getting back to the office. Talk to us, John, a bit about what the landscape is like right now for the office space in the United States. Are people coming back to the office?
They are. Thank you for having me, by the way, and good afternoon. Yes, unequivocally, we see increasing numbers of organizations ask their people to come back and, in fact, tell them to come back to the office an increasing number of days a year. It's been more of a step function, I would say, than a leap, if you will, that's been happening and building for quite some time.
John, where are we compared to, let's say, January 2020, though?
You know, a year, if you said 2020, we're getting closer, but we're not in the same place. So 54%, I think, of the Fortune 100 have said you're in the office 5 days a week, and that was probably 90% then. But hybrid policies, you know, have people in the offices 3 to 4 days a week. So it's, you know, somewhere in between, but far closer than we were a year ago. What
about from the perspective of inventory and how much leased inventory you have versus what you had back then?
There's a lot of ways to segment buildings. For that question, I think the easiest way to do it is the new, higher quality product, and then everything that's, say, pre-2015. And the first category is leasing very, very well at record rents. and occupancy levels are very high and vacancy levels are low. We don't have a lot of construction. We're going to run out of space. The older product is a different story, and leasing volumes there are nowhere near as high. And that's where the majority of any increasing vacancy is coming from older product.
John, I cover commercial real estate stocks for our U.S. equities team here at Bloomberg News, and we talk a lot about the bifurcation in quality office space in the United States. You have the Class A buildings, you've got buildings that are lower tier, and of course, you see a lot of these big corporations going for the higher quality buildings. As we look at the broader country and what it looks like for the office real estate space, where are you seeing areas for opportunity?
Well, I think well-positioned assets that are a little older, meaning a good location and good bones and a good footprint, because they would trade at a really meaningful discount. So you have, in the old days, we called that a value add play, but you invest some money, you're below brand new replacement cost, and you've got a very leasable building because you've spent a lot of money on it. So I would view that as an opportunity. And then I think at the high end, well-located sites, you all would be familiar with the Wall Street phenomena. A lot of financials moving jobs here, as an example. If someone were to break ground on a top of the market office building, my belief is in Dallas, it would lease quickly. So some of it's where you are. New York is very solid right now. And generally, the cities across the South are very solid.
And I know Park Avenue in particular here, we are seeing a bit of a tailwind here in New York City. But let's talk about the West Coast. Of course, we have a lot of those remote workers. We've got the tech industry that started going a bit more virtual, not paying as much. You're not seeing these companies forcing people as much back into the office as other industries. What is the West Coast office demand looking like right now?
Location's always been a thing in real estate, right? And we call that submarkets in our space. Submarkets matter a lot. In Northern California, dramatic change really started a year ago, and it's not necessarily big tech driven, but it's AI spawned industries and organizations and startups. So absorption of space has been very healthy in the Bay Area. LA is highly concentrated on the west side of LA, if you will. Orange County would be more typical. And then Seattle has been lagging, but we're starting to see recovery as Amazon and Microsoft and other great big name companies have said we're coming back to the office. You just don't see the job growth right now in the largest tech companies. It's more in the startup communities, so that's overweighted to Northern California.
John, you mentioned that New York is strong right now, and that's where Nora and I are located. That's where our headquarters is here at Bloomberg. And I wanted to ask you a question about this region specifically in regard to the mayoral election that's coming up. There's been some concern, especially from business leaders, that Zohran Mamdani might drive away business as a result of wanting to raise taxes on the wealthy and wanting to raise taxes on businesses. And he did meet with a bunch of leaders, 100 business leaders from the Partnership for New York City earlier this week to talk with them. Are you looking at that at all as being a risk to New York City commercial real estate?
Yes. I mean, would be the one word answer. I'll draw, I think, a direct comp for you. Last fall in San Francisco, in the city proper, we had a local election, as you too would be aware, and we had some of our agency professionals, people who represent the owners of the buildings, had leases ready for signature, and the tenants said, I want to see the outcome of the local election. And based on the way it went there, they ended up signing the leases and putting their people in the city. And I do believe that could happen in New York, but that doesn't mean it will as a certainty. I would take people at their word, though.
Well, talking a bit more about this Mamdani and the impact that it's having on markets here. Of course, we know that part of his campaign has been to freeze rents in New York City. So we did see apartment REITs, especially that have exposure to New York City, falling after the news. But I want to talk about office conversion, because, of course, we are also dealing with the housing shortage. And a lot of the conversation in the real estate industry has been about whether or not we're able to convert some of these office spaces into multifamily apartment properties. Is that something that you all are thinking about? And what is the latest status with that?
Oh, it's accelerating, and it's happening at a pace we've never seen in the commercial history. Again, as you know, Nora, obsolete real estate is not a new thing. People see houses torn down that are old and build newer, bigger, shinier ones. And so that can happen in all the asset classes, and we see that happening now. Now, as you know, not all office buildings lend themselves to being multifamily. The floor plate configuration matters a lot, and obviously the location in a given city matters a lot. But we do see unprecedented amounts in terms of numbers of building and total aggregate square footage that are being converted to another use. Hospitality is another likely candidate. That's probably the two most, meaning multifamily and hospitality. And we do have an affordable housing challenge, so that's good.
John, you guys are out with a 2Q U.S. office market dynamics report. And one thing that you argue in the report based on the data that you found is that there's essentially this turning a corner for the U.S. office market. What's the evidence that you have for that?
We're just looking at the data and statistics and watching aggregate industry decisions. As an example, law firms have very broadly said we're working out of the office, and they've been expanding their footprint for a year, taking more space. And the data is very clear that it says that. And you see office leasing volumes increasing on a quarter-over-quarter basis. There's also anecdotal data. If I walk down the hall here where I sit with the real estate brokers, they're positive. When they're in a better mood, it means volumes are good. And they're in a better mood, and they will tell you they're busy. They'll tell you they're chasing more opportunities. And people are making decisions at a greater pace, which is also cycle times is something we always measure and pay attention to here. And they're shrinking, which means people are making decisions faster. So all good news, and it adds up. John,
good to see you. Thanks for joining us. John Gates.
Thank you for having me. Great to see you.
Whenever the JLL folks join us, they're always joining us from the office, which I guess makes sense. Nobody's ever working from home. I can tell you that. John Gates, CEO of the Leasing Advisory Americas services over at JLL. They offer real estate and investment management services all over the world.
You're listening to the Bloomberg Businessweek Daily Podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
I'm driving in my car.
How about you let me drive?
Oh, no. This is not a toy.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
TikTok, everybody. Just about 18 minutes to the close. We've got a special guest for our Drive to the Close today. We're talking regional banks. We've got Herman Chan with us, senior analyst for U.S. regional banks at Bloomberg Intelligence. Herman joins us here in the Bloomberg Interactive Brokers studio. I just want everybody to remain calm, okay? Despite the fact that Herman is in our studio, nothing is collapsing.
Nothing is collapsing.
The reason I say that is because we got to know you so well a couple of years ago during the regional banking crisis.
Yeah, it's my claim to fame.
Each and every day, we spent so much time together. So it's nice to see you on a day when we don't have to talk about the FDIC.
That's right. Actually, banks have been pretty good this far in the earnings season. Actually, it's been pretty interesting because banks universally have beaten estimates, but the bar's a bit higher because of the run up over the past couple months.
Okay, so let's take a little step back because we've gotten earnings from, I think it's fair to say, the majority of them. M&T Bank, First Horizon, PNC Financial, Citizens Financial Group, Fifth Third, and U.S. Bancorp. We're going to get tomorrow Truist, Comerica, and Huntington Bank shares.
Right.
You would say if there is a through line to sort of tie all these companies together, at least the ones that we've heard from, things are good?
Yeah, things are good. Universally, the banks have beaten on credit. So the fears of tariff uncertainty and potentially worsening credit quality and higher loan losses, that really hasn't been apparent so far. And banks have been able to deliver some growth, which is interesting because you've seen some corporate clients and business clients front run some tariffs and build inventory ahead of higher costs. So that's actually been helpful for regional banks.
How are we thinking about this earnings season more broadly? Who are the outperformers here?
Yeah, so PNC has done probably the best so far. They've been able to deliver loan growth and also improve their net interest margins, which is their spread between lending and deposits. That's the one that has been the bellwether, and you've seen that outperformance from yesterday. Some of the other ones have been a bit more mixed because they've either haven't grown their loan portfolio or their net interest margins wasn't as robust.
How do we think about just leverage right now when we look across the industry? What are you seeing? What are the main takeaways?
The main takeaways really is, I was trying to preface earlier, there's a higher bar for performance given the 30% run up in stocks over the past 3 months. And on the back of that, the largest banks like JP Morgan and Bank of America were showing strong deposit and loan growth. So there's a higher bar for performance, and where things really stack up is, can the banks really drive top line revenues in the form of net interest income or fees?
When we talk about the 6 big banks, we often talk about Bank of America being a good bellwether of the consumer because they have so much consumer access. We talk about JP Morgan in a similar way. A lot of the focus of our coverage is about the trading revenues, and they were certainly good during volatility. The regionals serve somewhat of a different group of folks. We speak to Bruce Van Saun a lot over at Citizens Financial, and he reminds us that construction, small business, they're the ones who are powering their loan books.
Right.
Is that every regional bank?
The regional banks that I cover, which are the tier below the Bank of Americas and the JP Morgans, we're talking about PNC, US Bank, Truist, all the way down to OZK.
And when you say tier below, you just mean in assets?
In assets,
okay.
Right. So these banks really tend to cater towards the middle market, commercial customer and small businesses. Those are the bread and butter customers for
What
these
was the
banks.
commentary that they offered around those customers?
Yeah, so it's a bit more mixed. If you talk about the mid-market commercial, they're saying that they're still transacting. But on the other hand, there's not a lot of key capital spending that drives a lot of the loan growth for the regional. So depending on what you're seeing, some banks are talking about higher commercial line usage, which means they're just tapping their existing commercial lines for growth purposes. Like
that's a good sign.
So that's a good sign, but it could also mean that once the tariff costs really start to pull through in the economy, those line usage will be paid back.
Were there any concerns that stood out to you at all through these prints?
Yeah, hasn't been a lot of real concerns. It's really about if we get further loan growth, or if that can be persistent in the back half of the year, right? So if you take a step back, last year there was not a lot of loan activity for the regionals. A lot of it was due to the uncertainty with rates, with the election, et cetera. And then perversely with tariffs, you've actually seen more loan growth. And if that continues, that would be great for the regionals, but that's still a question.
I'm wondering about exposure to commercial real estate. One of our viewers, listeners, getting in touch about historically, people have been petrified of commercial real estate exposure when it comes to, at least that was in 2024. Is that still happening?
Yeah, so the commercial real estate exposure that is been in the spotlight has been office commercial real estate exposure in particular. And for these larger regional banks, it's the smaller in exposure. We're talking about on average about 2% of their entire loan book is office CRE. And they've had a lot of time to really build their bad debt reserves on these loans. So it's a known risk that they've been managing, and you see charge-offs come quarter after quarter, but because of the smaller exposures, it doesn't really move the needle that much, and they've been really conservative with building their reserves. In fact, you mentioned Citizens. They actually reduced their reserves, which means that they're just letting the reserves flow down as they incur more charge-offs. So that's just a sign of strong confidence that the portfolio can perform going forward.
So we know that U.S. lenders really came into this earnings season trading at or near record highs. I'm looking at the KBW Bank Index, that's ticker BKX, up 12% year to date. So essentially, we're hearing some people saying that high valuations among the big banks really is what tempered some of the enthusiasm surrounding the results. But how are you thinking about next steps? Where do we go from here?
The next steps really is there going to be a catch-up trade. So for the KBW index, the largest banks are really driving the boat here with JP Morgan and Bank of America, Citigroup showing outperformance for the year, whereas the regional banks have lagged a little bit, right? So because the regionals don't have the markets and trading exposure that you mentioned earlier, are they going to be able to catch up? And is the catch-up trade going to happen? That's what we're waiting to see. And really, that's really dependent, as I mentioned before, on growing the balance sheet and improving the net interest margins.
Herman, always good to see you, especially on a day where we're not talking about a regional bank collapse. So,
right.
Yeah, thanks so much for hanging out with us.
Thank you.
Herman Chan is senior analyst for U.S. regional banks at Bloomberg Intelligence. Check out his research and the research from the entire team on the Bloomberg terminal. He's here in the Interactive Brokers studio.
This is the Bloomberg Businessweek Daily podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg terminal.